I'm Charlotte McLeod with investingnews.com, and here today with me is Jeffrey Christian, managing partner at CPM Group. Thank you so much for joining me. Great to have you.
It's great to be with you. It's good to see you again, Charlotte.
Really good to see you and excited to catch up. As we mentioned before we turn the camera on, this is a very interesting day that we're speaking on. It's July 19th. So we'll get into some of the things that are going on in the markets a little bit later on. But before we go there, I just want to look back to our last conversation, which was in March at PDAC. So much has changed for gold since then. So I wanted to check in there with you first, look back at what gold has done in those months. I know you were looking for record highs for gold in 2024, but is this how you expected it to pan out?
No, the price levels we've gotten to are in the area of what we were expecting, but they've come sooner. And, we were thinking that political and economic factors would cause investors to be buying more gold and silver, and that would drive the prices higher. But we thought that we'd see the prices rise more modestly in the first half of this year, then kind of plateau in the second quarter and third quarter, and then pick up in the final 4 months of the year. And what we saw were stronger prices into April than we had expected. They did sort of plateau in a sideways way for gold. Platinum and palladium fell. Silver actually has been sliding lower. But we haven't seen all of the summer slump. I think investors are more concerned earlier than we thought they would be. But it's basically been in line. And, our big question to ourselves was, did we get the timing wrong or did we get the highs wrong? And the answer is that we got the timing wrong, that we think that we will see higher highs still over the course of the rest of this year, beyond August, and also into 2025. We think that, the prices are just going to be that much stronger than we had thought they would be.
Okay, and I want to talk a little bit more about what's been driving the gold price. Maybe you had mentioned investors getting concerned a little bit earlier. So what are the drivers you would identify? We've got that one, and what else is in the mix?
Well, one of the things that you've seen is that politics have taken a much more prominent role in investors' minds than usual. Usually it's economic concerns and financial market stability concerns that are the key drivers, and politics are in there. But this year it's politics, and it's domestic politics, obviously in the United States, but also you've seen some upset elections in France and in the UK. You have domestic politics in many parts of the world that are much more concerning to investors and financial markets. And then you have international politics, obviously the Russian invasion of Ukraine, the war in Gaza. So the politics have been very important. You've also seen, investors, we've been pretty accurate in saying, 2021, 2022, 2023, we don't see a recession then. We've been saying that we thought we'd see a recession in 2024, 2025. And the financial market consensus was, no, we're going to have a recession in 22, 23. And now they're sort of like saying, well, okay, then they pivoted and said, we won't have a recession, we'll have a soft landing. CPM Group's view was, a soft landing is just a prolongation of an expansion leading to the next recession. And there will be a recession. And you're starting to see markets now, the market consensus pivot back toward, okay, we are seeing slower economic growth in the United States, in Europe, in Japan, in China, and we may in fact be slouching toward a recession. So we have economic concerns growing.
Right. And I did have it on my mind to check in with you on what's going on with the recession. So that helps there. Do you think you could share your thoughts on, I guess, how deep of a recession, the length of a recession that we might be seeing? Your updated thoughts there.
Well, my thoughts are that we don't know. I mean, there's a lot of confusion. if you go back 2 years ago, CPM Group was projecting a relatively deep and severe recession in 2024, 2025. And over the course of the last couple of years, the economic conditions, especially in the United States, but also in other countries, have been somewhat better than we thought they were. So we have reduced the severity of the recession that we are projecting, but it's still a pretty significant recession. It's not one of those short, shallow ones like we saw in 1991 or 2001. Probably not as big and bad as the one that we saw in 2007 to 2009. But the political environment is such that it could be bad. Or what we could see is something similar to what we saw in 1980, 1982, which was a double dip recession, where you saw a recession in 1980. And it was relatively short-lived. It was severe, but it was relatively short-lived. We started to come out of it, but then we went into another recession, which lasted 1981 into 80 through 1982. And that is a possibility with an increased probability assigned to it due to the political environment, where you could see a short, shallow recession late this year, early next year. But then, if Trump gets into office and does what he thinks he would do, you could see a very severe recession 2025, 2026.
Okay. Yeah, I think there is a lot of confusion and people have a lot of questions about this. So thank you for going into that. I think that helps. And so looking at this political angle that you mentioned as well earlier in the year, this is really important in 2024. Gold's new all-time high that we just saw this past week, was that politically driven for you or other things going on there? How do you see that?
Well, it was partly politics driving that, but it was also some market conditions. So you have, like right now, if you go back to last Friday, you had 30 million ounces of open interest in the August COMEX gold contract. And typically that most of that open interest in the nearby active contract gets rolled forward over the course of the month prior to delivery. So, if you look at silver, at the end of May, July was an active contract. At the end of May, you had 733 million ounces of silver open interest in the silver COMEX futures contract. That's a lot of silver. And over the course of June, all but like 29 million ounces of that was rolled forward into September. So you had 29 million ounces or so. Actually, I think you had less than that going into the delivery period at the beginning of July, and about 29 million ounces of that has been delivered. It's still in the depositories, but the ownership is changing hands. So going into July, looking at the active August COMEX gold contract, we had about 30 million ounces of gold open interest in August. That would likely be rolled over or delivered, and last Friday, we still had 30 million ounces. It's down to about 26 million ounces yesterday. So one of the things that you were seeing on Wednesday was that the price had softened a little bit, and some of the people who were short the August took that opportunity to get rid of, more than 10%. So some of that liquidated it, and some of it rolled into the October COMEX contract. And that had the effect, when you're buying spot and then selling in October, that has the effect of driving the price up on a short-term basis.
Okay. And then the pullback that we've seen, I think we're around 2,400 right now, although I'm not exactly sure. Is that typical of what we would expect after such a move?
No. I mean, it's funny, on the 16th, so that was Tuesday, we issued a trade recommendation to our clients, and we said that we thought to go, we had been buying, these are ultra short term buy and sell recommendations, buy, sell, or stand aside. And we had, buy, then sell, take profits, then go long. And on Tuesday, the 16th, we said, stand aside because the price is like $2,450. And quite frankly, the range could be somewhere between, for the next few days, could be somewhere between 2,400 and 2,500, $100 spread. And we thought that was outrageous. And a lot of people said that's outrageous. That's a ridiculous, $100 spread for the next 2 weeks. And so we went up to $2,489 on Wednesday. And then we got down to the prices, the price got down to $2,395 this morning. So in 2 days, you had a $95 spread. It's very unusual to see that kind of volatility. And so today we issued a buyback, an updated trade recommendation. And we said, as outrageous as a $100 spread sounded on Tuesday, we're saying $200 is possible now. So if you are gutsy, you can buy or sell. Right? The price we think is going to be extremely volatile for the next couple of weeks.
Well, and we do have all this turmoil that's erupted today in the markets, and I guess normally people, or at least I would think people would go to gold as a safe haven, but it seems like those dynamics are not quite in place at the moment. Is that what you're seeing?
But you have to be fair to gold. I mean, the prices of gold, silver, platinum, palladium, copper, and other assets all fell, commodities all fell today. The stock market was off 500 points yesterday, the Dow Jones. So the volatility is not limited to gold and silver. I know that, the gold bugs and silver bugs like to say, oh, well, look at what's happening in silver. And it's like, yeah, it's almost as bad as what's happening in platinum and palladium and copper and oil and gold. Actually, gold and silver were much more volatile today than those others. But, to be fair and honest to gold and to silver, what you're seeing is a much more general financial market volatility and instability.
Okay, I think that's really important. Sometimes definitely we are not fair to gold, and to look at it in that big context is very helpful. So we talked back in March about that political angle that was very important, but you also brought up the investment demand for gold. So I wanted to take a look at that as well and see where that stands over the past few months and what we're looking at right now. Where are we seeing strength? Where might we be seeing less strength?
Well, what we've seen over the prior 3 years, 2021 through 2023, what you saw was an increased level of investment demand for gold and a decreased demand for silver and decreasing demand for silver. But looking at gold, you saw investors buying more physical gold over the last 3 years, even as shorter term investors involved in ETFs and futures were kind of backing away. And it wasn't so much that the ETF investors were bearish on gold, they were worried about counterparty risk. And so you saw people selling ETFs. Initially, they were selling smaller ETFs and replacing them with bigger ETFs. But then over the course of 2023, they were getting rid of the bigger ETFs and moving into physical gold directly owned. And that has continued in the first quarter of this year. But then in the second quarter of this year, as the gold price was moving to higher highs and new records, I think we set 2 or 3 new intraday records in April alone. You saw shorter term investors coming back into the market. So you've seen a big increase in open interest and trading volumes on futures exchanges, and you've seen a revival of demand for gold ETFs. And that's basically shorter term, more opportunistic investors saying, hey, okay, I thought that the gold rally was over, but maybe it's not. And the easiest and quickest way for me to buy exposure to rising gold prices is through gold ETFs. So that's what I'm going to do. So we've seen those longer term investors continuing to buy more gold. And in the first half of this year, they were buying more gold than they had been in the previous 3 years. But now they're being joined by shorter term investors and other investors who are not necessarily ongoing, regularly scheduled investors in gold and silver. They're more generalists, but they're looking at gold. They're looking at a stock market that is very highly valued, record stock indices, but very tenuous, with just a few large companies that don't have good earnings. They are being accounting for most of the upward pressure, demonstrable index increases, and a lot of other stocks not doing so well. So there's an increased nervousness about the vulnerability of stocks that's causing generalist investors to say, well, where do I park my money? And, the dollar's been strong and high, and that's okay. It's fairly valued. So you're seeing some of that money move into gold, silver, and copper, and platinum and palladium to a lesser extent.
And how does that divide geographically? I think I've been hearing a lot over the last several months about how important China has been in terms of gold demand. So how do you see that?
China's been very important, but the demand's been very well spread around the world. So when people say, well, who's doing the buying? Our flippant answer is everyone. Yeah. And you're seeing strong demand for gold in China, India, the United States, the UK, Japan. It's really been a much more generalized investment demand, institutional and retail investors. So, everyone's worried.
Okay, I think that gives a good picture of what's going on there. I think we should also look at what's going on with the Fed, because that just always seems to be something that people want to hear about. So this past week, we had Powell talking about interest rates and how they won't wait until inflation gets down to 2% before they cut. Although, of course, he didn't give us a timeline on when that cut is going to happen. So any thoughts from you on when we may see that first rate cut?
Um, I'm thinking that it comes late this year or early next year. The Fed doesn't like to make interest rate changes before a presidential election. It did, it raised interest rates in, I think, the third quarter of 1992, and George H. Bush blamed the Fed for him losing the election. In fact, he had a lot of contributions to his own loss, but he blamed the Fed for that. And the Fed doesn't like to do that. It only did that in 1992 because it really was looking at the economic environment at the time and said, we have to move. We can't wait until December of 92 or the first quarter of 93. So they're sort of in the same situation. I don't think the Fed doesn't want to make an interest rate move before the election. There's one thing that's there. Donald Trump has threatened the Fed not to cut rates before the election. And, the Fed doesn't like to be threatened. And, I know, given my historic and my youth in a tough neighborhood in St. Louis, when you threaten me, there's usually a negative consequence. So I think the only reason the Fed would lower interest rates before November is because Donald Trump threatened it. I don't think that the Fed will make that policy change based on some sharp-fingered vulgarian threatening them. I think that they will probably wait, and they're going to wait to see further signs of economic weakness. One of the things that financial markets have gotten wrong consistently for the last 2 or 3 years is to say, I know what the Fed's saying, but I don't believe it. This is what's going to happen. And the Fed has been extremely accurate and honest, saying this is what we're going to do, and then doing it. And the financial markets have been consistently wrong by saying, no, the Fed's not going to do that. It's going to cut rates sooner. And for 2 years, the markets have been wrong. I think that investors are best served by believing the Fed. And the Fed is saying, yeah, we will cut rates at the right time. we're not going to cut rates because economically everything is good. We're going to wait to see that there are signs of negative consequences to 5.25 interest rates. And that's probably not going to emerge over the next 3 or 4 months. But yeah, I wouldn't be surprised by the end of the year or early next year if you start seeing greater economic weakness, greater economic problems, and the Fed feeling that it needs to lighten up on interest rates to be a little bit more accommodative than it already is.
Okay. And so you mentioned how wrong we've been about the Fed over the last couple of years. And another popular narrative that I hear a lot is gold will really start to move when the Fed cuts. So is that another thing that is wrong?
Probably. I mean, yeah, there are a lot of people who opine about gold and silver who are consistently wrong their entire lives, and that's one of their popular things. I mean, one of the things that we've seen this year, which is very interesting, is uh, lower inflation has correlated with higher gold prices. There are all these people who tell you that gold is an inflation story. High inflation means high gold prices. And what you've seen is actually, and there's also people who say that higher interest rates are negative for gold prices. And what you've seen is that higher, if that's what you want to call current rates, that have been relatively flat now, they've been unchanged for, I guess, more than a year. Uh, the higher interest rates are now seen as pro-gold because they mean that inflation is more persistent. And declines in, I mean, look, inflation was 9% at the beginning of 2022, and it's about 3.2% now. So we've lost 2/3 of those inflationary pressures. And if you look at the most recent CPI figures, food prices are actually coming down, one of the more volatile sectors, as are a number of other factors. You still have services and transportation as having some persistent inflationary pressures. So it's funny that lower inflation and higher interest rates have been more closely correlated with rising gold prices in the face of these talismanic beliefs that people in the gold market have and persist in having, even though there's no quantitative basis for them.
It's very interesting, and it is very tricky to follow. So that was also very helpful. So you gave previously your outlook on the economy when we might see a recession. If we look over to the stock market, I guess one of the persistent narratives this year has been, all the drivers from the large tech stocks that are focused on AI. And certainly they've not done so hot this week. So I wonder what you see coming there just for the overall stock market.
Well, there's a few things. First off, I am very unimpressed by AI. The AI tests that we've done, I would have fired the guy. And some of the AI things that people are giving to us are just garbage, And it's interesting because my old alma mater, Goldman Sachs, has now this week come out with a piece saying AI is not at all as good and powerful as the markets seem to think. So I think that's a real vulnerability for the stock market. Because as I said earlier, if you look at the stock market, we have record indices, but those indices have been pushed up by these hollow companies that promise future profits. The Tesla thing. It's like, my PE ratio is 100-1. Or Nvidia. It's like, and so that makes the stock markets more vulnerable, and that's a real issue. But then that, coupled with the idea of slower economic conditions, further constraining the profitability of smaller companies in the stock market, makes the stock market that much more vulnerable. I don't see a collapse, but I could see a significant decline in the stock market. And I would add that, as Leon Kuberman always said when we were working together at Goldman Sachs, the stock market has predicted 13 of the last 4 recessions. So the stock market can give up 20%, 30%, 40%, and we don't go into a recession because the stock market is not the economy. And in fact, the stock market is less related to the real economy now than it was 40 years ago when Leon and I worked together.
Okay, I can tell you I'm definitely on the same page with you on AI. I've looked at, I feel, so many different tools. I'm trying to keep an open mind, but I'm not seeing all the greatness there, at least at this point. Okay, so aside from gold, I also wanted to check in with you on silver. So silver has been on the move this year as well. Is it following gold? Is that the main thing that's going on there, or are there other important factors for silver that are at play also driving it?
Well, there are other factors, and some of them are positive and some of them are negative. So, silver and gold broadly move together, as do copper and platinum and palladium. And there is this broad upward move. But silver also has had some investment demand pulling the price higher based on the idea that solar power panels are going to be using much more silver. And it is true that solar panels are using more silver, electronics are using more silver, but it's not nearly as bullish as some of the projections are that you see. But that's being offset now, and has been being offset for at least 18 months, 19 months now, by negative investor attitude. Some of it is sour grapes because, the Wall Street silver boys were just wrong. It was not that they were lying; they just made up stuff and said it. Um, um, there are people who are disenchanted investors who have been selling a lot of silver, and there are other investors who look at the solar panel hype and say, "This is hype. I'm not going to buy into it. If anything, I'll short because people are keeping it up." So there has been a lot of, we report net investment demand of physical silver. And it's very low, but it's still positive. But that net is comprised of gross investment demand, buying, and gross selling by investors. And you've seen increased gross buying and increased gross selling over the last 18 months or so in silver. And that's why if you look at the gold price, it got up to 24.50 or 24.40 something in April, and it's been trading between 2,300 and 2,450 since April, May, June, into the middle of July. And then you've got this broad sideways channel. You've tested 2,300 3 times. You've tested 24.40, 24.50 3 times. If you look at silver in comparison, it rose sharply in April, and it's been trending lower ever since then. And that reflects this greater disenchantment on the part of some investors in silver and increased gross silver sales by investors that are offsetting the gross investment purchases. So silver's got its own rhythm and a section, and the base is working its way down the fret, not up the fret, to keep that metaphor going. So silver has some more negatives than gold. That doesn't mean that its price won't rise and won't rise again. It won't rise strongly. It just means that there are greater headwinds than with silver than there are with gold.
So, okay, if we keep that in mind, the price trajectory in 2024, are you seeing it then higher? Or maybe another question to add there is, all these disenchanted silver investors, what might cheer them up and get them excited again?
Rising prices. Yeah. I mean, we've seen this before. We saw it in the late 80s and 90s. And you had, net investor selling from 1990 to 2005. And the price of silver started rising while you still had net investors selling, because you started seeing decreases in the amount of silver being sold on a net basis and on a gross basis by investors between 2002 and 2005. And at some point, investors collectively said, if I stop selling or if I wait a day, I might get a higher price tomorrow than I got today. And so it wasn't net investment buying that initially pushed the silver price up. It was less gross investors selling. And then as that kept the price moving higher, 2002 to 2005, slowly, what you saw was that investors say, okay, I'm not going to sell it at all. In fact, I'm going to buy more. The exact same dynamics happened in 1979 when the price went from $5 to $50 the first time. It's the exact same mechanism. Higher prices will feed into investor enthusiasm for gold, silver. And so when you see the silver price rise back to 32, and we think it will probably over the next 5 or 6 months, we would expect investors to start buying more silver. And if that investor demand persists, then it feeds itself and the price rises further.
Okay. Okay. Yep. That certainly sounds like a familiar silver story. So, in addition to gold and silver, I wanted to take a little bit of time to look at the platinum group metals because CPM Group just recently released the big report for the year. So, looking first at platinum, that's a metal that I believe has been range bound for at least the last several years. So, if we start there, is that a scenario that's likely to change, or are we going to continue in this holding pattern for platinum?
Yeah, we had thought that the silver price or the platinum price might show some greater strength than it has. But the reality is that the fundamentals of platinum and palladium are more negative. And that's because their major use by far is auto catalysts. And you're losing market share to electric vehicles, and you're losing within the auto catalyst market, your palladium's being substituted away into platinum. And we thought that platinum prices would be somewhat higher, but they haven't been. And what you're seeing right now is investors primarily are playing platinum and palladium from the short side. They're negative on it on a longer term basis. We have seen an increase in investors interested in buying platinum and to a lesser extent palladium going long, but they tend to be more shorter term investors who are saying, the price is so low. And to some extent, we've fallen into this trap too, And in fact, I think today we're issuing a buy recommendation. We issued a buy recommendation 2 weeks ago on the 5th of July on an ultra short term basis for platinum, looking at the technical price charts, the price activity, saying it's low and it's going to rise, and also looking at the open interest and the increase in institutional investors going long. They're still net short, I believe, but there is some increase in investor willingness to go long platinum in the expectation of short-term price increases. It didn't happen. And in fact, the platinum price has fallen. And so, if we were bullish on platinum a week ago at $1,040. We're more bullish on platinum at $970 on a short-term basis, ultra short-term basis in the next couple of weeks. Longer term, we see flat to lower platinum prices and flat to lower palladium prices because you are continuing to lose market share. And the big positive that you see for platinum and palladium is that the South African producers are producing less metal, partly because of the lower prices.
Okay. So is the message then if you want to be involved in platinum and palladium, you should probably be looking at these short-term trades versus longer term?
If you are a long only investor, yes. If you are long short, then you probably want to trade. Maybe you're long short on the short term basis, but from a longer term perspective, you want to be short.
Okay. I got it. All right. I think those were many of the topics that I wanted to cover today, but I'll put it back to you. Are there any thoughts that you would leave investors with? It looks like we're in the summer, which is usually a calm time. It doesn't seem to be very calm this year, and heading toward an interesting fall.
Yeah, I don't. Yeah, the sometimes the summertime doldrums don't occur, and this is one of those years. And it's funny. I was talking to my wife this morning because we have the Democratic convention going, or the Republican convention going, and the Democrats are like sort of being quiet and letting that happen. And I pointed out that we had a bearish sell sign for intermediate term basis on gold from January 1988 into, well, we officially went bullish in early 93. But in August of 92, we started telling our clients, these are the 4 or 5 reasons that we've been bearish on gold. And these are the 4 or 5 factors that we've been looking to change before we turn bullish on gold. And in August of 92, we started telling our clients things are changing. And the big thing that we watched was coming out of the Republican convention in August of 92, there was no bounce for George H. Bush. And that meant that this political unknown, Bill Clinton, was likely to win the presidency. And you'd have a Democrat coming in as opposed to 12 years of Republican rule. And we said, the things that we've been seeing as negative on gold are dissipating. The things that are being positive for gold are appearing. There was one thing, which was there was a large central bank that had sold a large amount of gold forward in the January and February delivery periods. And we said, that's going to hang over the market until it's gone. So if everything holds together by February or March of 1993, we're planning to issue a buy recommendation on gold. So you might want to prepare for that. And some of them did. They bought long dated calls that were way out of the money, that were pennies on the dollar. And people said, why are you buying these things? And then they all went into the money in the first half of 1993. But the trigger was that George H. Bush got no bounce from his convention in his poll numbers. Now, initial numbers are that, getting shot at didn't really help Trump, but it's not so much, we don't know how much it is the convention and how much it is Biden's problems. Our view is that Trump has benefited more this week from Biden's problems than from the convention. And we're going to wait and see, because there's been a lot of stuff said at that convention. And J.D. Vance may turn out to be something of an albatross around the neck of the Trump campaign, especially as more things about his background come out. And there are more things to come out. So we have to wait and see. But right now, Trump has gotten a bump in his ratings, which is what he likes. He likes ratings. We like poll numbers. The poll numbers are garbage. Everybody knows it, but that's what they are. And he has gotten a bounce this week, but we have to wait and see how persistent that is. That's really one of the factors on an ultra short-term basis that we're looking at.
Okay, that's really interesting. And one small question, just because you mentioned Trump is perhaps benefiting more from Biden's problems. Do you think Biden stays in this race?
I want to be an equal opportunity. People think I'm a Democrat, and no, I hate all political parties. I would never belong to a party that would have me as a member. But I am not even sure that the Democratic Party is a party anymore. I sort of see them as a bunch of motorheads. But I think that Biden probably drops out. And I wouldn't be surprised. I don't know when you're going to release this. We're talking on Friday afternoon. Things like that often are announced on Friday evenings. and I wouldn't be surprised to see by Saturday morning if he has bowed out, because I think it's increasingly obvious that his cognitive abilities are deteriorating rapidly, and I do think that he could beat Trump, but I don't know that he could run the country for the next 4 years. So, I want to, I've said some negative things about Trump, but let me, say, that doesn't imply in any way that I have positive things to say about Biden. Yeah.
We might need that. But okay, I think we'll leave it there. This is really good to have you. Lots of good insights there for investors, both short and long term. So thank you so much for coming on to go over what's happening.
I would add one thing.
Oh, sure.
On October 7th, October 7th, 2016, we were in our market meeting, and we said, it was Hillary Clinton versus Donald Trump. And we said, well, what's the gold market consequence of a Clinton or a Trump victory? And we decided that either one would be good for gold, at least on a short-term basis. So we structured a butterfly straddle for our clients. That basically, it was for the December contract, which expires in late November. It was an options contract. And on October 7th, we sent this to our clients and we said, we think that the gold price goes up regardless of who wins. So put this in place, and it costs like $4 an ounce or something like that to do. And it returned, we said, okay, liquidate it on November 9th. So like 2 days after the election, 1 month and 2 days after its inception. And the return was 125.5%. We're planning to show our clients a similar butterfly straddle this year.
I think we'll leave it there. This is really good to have you. Lots of good insights there for investors, both short and long term. So thank you so much for coming on to go over what's happening.
Okay, take care.
You as well. And once again, I'm Charlotte McLeod with investingnews.com. And this is Jeffrey Christian. Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.